Our final criteria is collectibility. So we've gone through the first three where we have evidence of arrangement. We need to determine whether the fee is fixed and determinable or how much of the fee is fixed and determinable. Then we need to deliver or perform the obligation within the contract. And then finally, we need to assess whether we're going to be able to collect the fee from the customer. And so that is the question of whether the customer is credit worthy. Do they have the ability to make the payment? Are they dependent upon payment from their customer in order to pay us? That would say that the fee is not collectible. As we mentioned earlier, if the fee is not collectible or there's some concern, well, then maybe we'd recognize revenue when the cash is received rather than on an accrual basis. Collectibility may be a concern that relates to specific regions, to specific customers, to specific industries. All those may color our assessment of whether a fee is collectible. The key with collectibility is that we need to determine collectibility at the time of the sale. So on the day we sell something to a customer, we need to determine whether that fee is collectible on that day based on our best understanding of the customer's financial condition. Most companies do some sort of collectibility or credit analysis for a customer, for new customers, and for ongoing customers to determine whether they should make deliveries to that customer or whether they believe those transactions are collectible. There may be situations where you would sell to a customer even if collectibility was uncertain, particularly in the software world where there's no incremental cost to the sale and there's a good chance that you'll get paid. Then maybe it would be a good business decision to make that sale to the customer. Or maybe it'd be a good decision to make a sale to a customer because that may help their business and they may be able to make the payments in the future. But if they were unable to demonstrate the financial wherewithal to make those payments at the outset of the arrangement, then maybe we would consider that transaction to not be collectible and recognize the revenue as the cash is received. We need to document our credit review process and have contemporaneous evidence of how we determined that that customer was collectible or that transaction was collectible from the customer at the time of sale. Because if the customer doesn't pay in subsequent periods, we need to determine, was that revenue and bad debt or was that no revenue at all? And you can see this is a revenue recognition webcast, so what we're talking about is our concern is that the revenue recognized, the revenue on the income statement is correct. If we sold something to a customer for $100 and recognized revenue, and subsequently they didn't pay us and we wrote that off as a bad debt, we would have $0 in net income, either in our income statement or ultimately in our retained earnings from that transaction. But if we recognized revenue and subsequently wrote off that receivable, in one period we would have revenue on the revenue line item, and in that period or a subsequent period we'd have a equal expense. Our revenue would not be recognized correctly if that transaction wasn't collectible at the time of sale. Now, if it was collectible at the time of sale and events happened in the period between the sale, delivery, and the collection or the attempt to collect from the customer, then maybe it would be appropriately a bad debt. All that's going to depend on the documentation that we have at the time of sale, because an auditor or a regulator looking at the transaction with hindsight would know that it had not been collected and could assert that it was not a bad debt expense, but it was in fact not revenue at the outset of the arrangement. It's very difficult to argue that a customer was creditworthy and the sale was revenue, and then in the same accounting period write off that sale. Or to recognize revenue in a prior period for a transaction and only getting the collection for that sale in current periods when we sell them additional items. So those would be evergreen sort of situations where the customer always has a balance and only pays when they order something new. This used to be the business practice in the record industry many years ago, where a small company would have a hit record, but they could only get paid by their distributors or by their retailers for that hit record when they had a second hit record. In those cases, really you're only going to collect from your customer based on future events. Then those sales are probably not collectible and should be recognized on a cash basis. And generally we would say collectability is probable if we're in that 70 to 80% of collection probability. And those steps, that collectability is usually determined by a company evaluating the financial statements of their customer, looking at credit references, looking at recent news items about companies, their financial statements, their stock price. If the stock price is dropping rapidly, maybe the investment community is questioning the viability of that company, and we should factor that into our determination of whether the sale is collectible.